Well, holy smokes, we got a lot of things going on this morning, including data that came out this morning. I'll give you a breakdown on the data dump, but first, we got to talk about Newsmax because holy smokes, this morning I sent an alert to course members that Newsmax is going to be the meme stock of the day. And remember what happens when you get into meme stocks, you better have your trailing stop because boy, those things, when they go down, they go down. But boy, oh boy, a shout out to the people, the brilliant minds over at Newsmax because they know how to play this. Why would Newsmax IPO at $10 and end up at $158 at the time of this recording? I'll make this really simple for you. 5.8% of this company is available to trade. That's it. So imagine you were in a desert and people were starving. And there was a piece of pizza, or like a whole pie of pizza that was available to eat, but only one slice was put out. Well, there'd be a frenzy for that one slice, and that's basically what you've got here. The value of that rest of the pizza just got so much more valuable because of the freak out people have over that tiny sliver. There are too few shares to actually absorb how much demand there is. And keep in mind, Newsmax is going to be pumping their stock like crazy to all of their subscribers, obviously. This makes sense. They're a news company. And they have this is not supposed to be a derogatory phrase. It's just the easiest way to put it. They've got the MAGA alignment, right? I don't know why some people think saying MAGA is like an insult. Make America Great Again. It's a movement. So the MAGA alignment is actually really, really good for them because their revenues are probably blowing up under the association with Trump right now. Now, we just got an annual report from them, so I can go through some of the numbers with you. I'll give you just a quick look at these numbers because I do want to get into some of the economic data that came out this morning. When it comes to the financials of this company, their online digital subscriptions are shrinking by about 5.4%, leading to some losses in that segment. But their broadcasting or TV section, likely because of their exposure again to the MAGA alignment, is up 41%. Massive growth in 2024 versus 2023 from broadcasting, so straight up TV. And this makes a lot of sense. 41% growth. This is what people love to see in an IPO, so they're probably IPOing, on the back of peak election time frame here. You've got advertising revenue up about 1.2%, affiliate fees up 1,000%, subscription fees. You've got some real movement here in revenues, which is very impressive. Now, when we get to their total financials, their balance sheet is okay. It's not great. They've got enough cash to cover, enough cash and investments and receivables to cover most of their current liabilities. And some of these will probably be paid off in stock, such as their derivatives or warrant liabilities, deferred revenues. We're not so worried about those anyway. So the balance sheet for the next year is okay. It's not like they're on the edge of bankruptcy or something. However, the company does lose money. You can see that despite that explosion in sort of the broadcast revenue, their total revenues at $171 million are leaving them with a gross profit of 84. But once they advertise, pay their employees, their rents, professional fees, $3 million of depreciation, other corporate matters, some of this could be related to the IPO. We'll look at that in just a moment. They have a net loss of about $72 million. And they've lost money in 24, 23, 22. So this is not a company that has ever been profitable. However, they might be able to pull off some money raising with the movement in their share price, pump up their balance sheet, and maybe reinvest into their own business a bit, which will be very interesting. As far as this, it looks like they have a settlement of about $40 million payable over time due to some legal matters, including lawsuits filed by Smartmatic and other affiliates of Dominion Voting Systems, where Dominion was seeking $1.6 billion in damages. And so some of those expenses could be one-time expenses. Does look like they'll still, even if you uncount those, still be close to a loss at the company. But a lot of enthusiasm for Newsmax, again, heavily related to a lack of shares outstanding. With that said, the data this morning on the economy was not the best, and I wish it was an April Fool's joke, but the data this morning was a little heavy. The JOLTS data and construction data, as expected, wasn't that impactful. You can go to the Meet Kevin website, so just go to meetkevin.com. You could be part of the membership where we broke down, pay attention to these and not these, and that way you have tradable information that you could play with in terms of, hey, like here's something to watch for. And what we warned was that construction and JOLTS probably wouldn't matter. They didn't, mostly because JOLTS, think about it, it's from February. It's kind of dated data. It's not that useful right now. And not only is it somewhat dated, but the JOLTS report, usually what we find with these jobs-related reports from the government is they'll tell us good numbers, and then they get revised down in the future. So it seems like there's a lack of reliability there. What was a lot more impactful, I think, especially on future pricing here, is that ISM report that we got this morning, which wasn't great. The ISM report this morning in March indicated that manufacturing slipped further into contraction after expanding only marginally in February. Demand output weakened. New orders fell further into construction. New export orders dropping into contraction. The backlog of orders contracting at a faster rate. Customer inventories remaining too low. In other words, people aren't willing to actually fill up their inventories because they're uncertain about the future. Companies are revisiting production plans. The employment index moved deeper into contraction. Companies continue to release workers via attrition as opposed to layoffs still at this point. This is why we say when we get to layoffs, they could hit hard and fast. People call it the gray swan that we know is there, but nobody's really paying attention to right now. Demand and production retreated as destaffing continued and panelist companies responded to demand confusion. 46% of manufacturing GDP in March contracted. That's way up from the 24% we saw previously. Here are some comments from other industries. In March, markets saw a slowdown with fear and inventory stocking to hold through a potential crisis. Questionable medium to long-term demand due to government policy, including retaliatory actions by other countries. Starting to see slower than normal sales in Canada. Concerns over Canadian boycotting. Business conditions deteriorating at a fast pace. Expect this short-lived demand from, the pull forward of tariffs to be short-lived. No evidence of growing demand. Worldwide economic instability has begun to impact our oil and gas business. Uncertainty about whether or not demand destruction is going to occur as they raise prices. And all of these things really negative, these reports. In fact, about one person hired comments around one person being hired versus 1.3 for staff reduction comments. So hiring freezes and attrition really affecting this economy. Not in the layoff process yet. And in really overall, this ISM report, it was a miss across the board. All of the numbers basically missed. It's a little boring to read the numbers, but you had misses on each of them. And that is in addition to the S&P Global report that we got this morning, which also wasn't that fantastic. It read very, very similarly. It actually on its headline beat a little bit. So there was some enthusiasm around, it beat a little bit. But when you actually looked at the report, it wasn't that great. Hiring stalls as orders rise only modestly. Sector growth stalled, having grown strongly in February, partly because of tariffs. Employment numbers unchanged after 4 months of gains, largely due to the impact of tariffs. Highest level of input price inflation in 2.5 years. Drop in production, first time since December. Modest fall was a stark contrast to the fastest rise in production we saw during February. Mostly, again, that pull forward. Everybody's trying to get ahead of those tariffs. You can see it here. Cracks are now starting to appear. Production fell for the first time in 3 months in March, and order books are becoming increasingly depleted. This idea that order books are becoming depleted is problematic because this means some of the data that we've recently gotten is exciting, but it might not last, causing firms to, quote, stop raising payroll counts for the first time since October. Supply chains are also suffering from a degree not seen since October 22 as delivery delays become more widespread as everybody's trying to run ahead of tariffs. Sluggish demand growth and elevated costs weighed on hiring. Levels of work outstanding declined in March at the fastest rate since December. That's not good either because it's a sign that the amount of future ordering that's available is going away, and that leads to laying off. Against the backdrop of falling output and slower order book growth, manufacturers signaled a modest cut in manufacturing activity. So, overall, both of these reports relatively negative in the face of a market that's very hopeful we can avoid a recession and is very hopeful that we have a buy the dip opportunity here and we can rebound. So far, we're not seeing any kind of major stress on the the 210 curve. You'd expect to see some more drama here, although the bond market is rallying today. So a lot of people who are investing into tickers like TLT or TMF, very, very happy today, as some of this data is recessionary. And even Barkin this morning from the Federal Reserve, as he was speaking at the Council on Foreign Relations, talks about this idea that the bond market is pricing in more of a recession risk than the stock market, which on one hand creates opportunities. If you don't think there's going to be a recession, well, great. Then, the bond market is overblowing it and the stock market isn't really pricing it in yet, which creates some opportunities. If you do think that there is a recession coming, then the stock market's still relatively elevated relative to the bond market. Anyway, if you're interested in diversifying to real estate, consider checking out my real estate startup House Hack. We're doing a non-accredited fundraise, so anybody can invest. Go to househack.com. Check it out, see if you qualify for the Reg A rules. Most people can qualify, I suspect. But anyway, go to househack.com. You get a 5% yield plus 100% of the upside in the stock. If we IPO one day and Newsmax style up, that'd be cool. And you get downside protection as well. So go check that out over at househack.com, and let's see how markets move. But so far, it seems like markets are very happy. You've got the NASDAQ fully recovering after some of this rough data that we got this morning, which is not a surprise because there's been so much selling off on this tariff news. A lot of people think, just like we saw at the end of the day yesterday, markets are due for a rally once we actually get the news. So it's sort of like sell the rumor, buy the news is somewhat what markets are moving like. So we'll see what happens. But anyway, happy April Fool's Day. This is all the data for this morning. Hopefully it's useful for you. And if you like it, make sure to subscribe to the channel and see you again in the next one. Thanks so much. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.